Yeah, absolutely. I think you hit the nail on the head there. And we were also wondering, before going into it, how the compromise would shake up. And that was clearly one of the things that is in there. I think another thing that is in there is that they maintained, in my opinion, a sort of a hiking bias because they do stress the inflation risks, and they do indicate that they want to bring rates to something that they call sufficiently restrictive. And that seems to be not exactly at these levels. However, having said that, obviously the market is pricing in already further hikes down the road, and so most analysts, us included, expect that. So I think the real thing is that on the one hand they stepped down the interest rate increases, on the other hand they kept the hiking bias, and as you said, they did surprise to the upside when it comes to the APP reinvestments.
Peter, I want to take you to the euro. I actually tweeted earlier on in the day that before this meeting, 80 basis points of cuts were priced in for the Fed, and another 67 basis points of hikes were priced in for the ECB, taking into consideration what was priced in for today. To my mind, that did sound a little bit stretched. The market is basically saying that the ECB have, in addition to today, maybe 1 or 2 more hikes to go, whereas the Fed are likely to cut by almost 80 basis points, or three times by the end of the year. And if you look at that interest rate differential, that probably is determining where the euro is headed from here. So if there's any disappointments on either one of those legs, isn't there room for downside on the euro?
I think once again it's pretty spot on, and it mirrors sort of what we are thinking as well. When exactly that catalyst will come is very hard to say, but certainly what we have been saying to clients of late is that the upside to euro dollar seems to be somewhat capped at these levels, precisely for the reasons that you've just been pointing out. And when you look at sort of what is priced in the Fed curve, we see that the risk is that this won't be delivered to the magnitude that's currently priced, and probably not to the speed that's currently priced. And keep in mind, up until the next Fed meeting, there's at least 4 big data points that all have been reasonably strong. There's 2 non-farm prints in between and 2 CPI prints, and all of those could alter the balance of risks. And for the ECB, of course, the market seems to be reasonably priced at this stage. If anything, I would probably also go against the implied cuts at one point. But as you point out, compared to the Fed, it's almost small beer. So I would agree with your analysis.
Peter, how do you advise clients think about the relationship between the Fed and the ECB? The Fed yesterday opened the door to pausing at its next meeting. If the Fed pauses, what does that mean for the ECB?
Well, I mean, I guess we're going to get that question or form of that question to Lagarde in the not too distant future. But I mean, one of the things that the ECB stresses continuously is that they're independent, that they're different economies and all that type of jazz. But at the end of the day, that's obviously not true. The trade links are there, the market links are there, and it's very rare if you go back over the existence of the ECB that they go in opposite directions. And in fact, there were only 2 times where they really delivered something whilst the Fed was either already cutting or indeed was on pause, and both of them haven't really endured, and both of them haven't gone down well, and both of them probably in hindsight have been interpreted as a policy mistake. So I can see that they have to extend a little bit. If, let's say, the Fed is on pause, which is also our call now, and that they keep going for a while, but that's just playing catch up. They started later, but they really sort of keep going for a prolonged period of time, whilst the Fed potentially even goes in the opposite direction. I think that's just not a credible scenario, in my opinion.